Increasing concerns about falling commodity prices and the high Australian dollar has triggered the RBA to lower the official cash rate to 3.25%. Today I'm joined on the line by Ben Jarman at JP Morgan in Sydney. So Ben, this cut is the lowest in 3 years. Were you expecting this?
Well, neither we nor the market were expecting this rate cut today. We did think that there has been a broader case for easier policy, but we thought that was going to take a little bit longer to become clear in the data. The RBA has so far been quite reactive to inflation data, and we thought they would wait until next month or perhaps a month after that before cutting rates. But it seems like the gradual realisation that global growth next year is looking pretty weak, and the fact that commodity prices have almost certainly peaked. Officials have come around to the idea that there's going to be quite a few drags in place for the domestic economy, and in particular the peak for the domestic capex pipeline in the resources sector looks like it's closer and smaller in magnitude than previously expected. So that's what's driven the rate cut today.
If the RBA decision is passed on in full, it will reduce approximately $50 Australian in the monthly repayments on an average mortgage of $300,000. Now, do you think the banks will pass on the full benefits of this cut to borrowers, or what are you expecting to happen?
Well, on the recent evidence of what the lenders have done so far over this easing cycle, the pass-through has been less than complete. So far after today's announcement, we've had one lender come out and reduce variable mortgage rates by 20 basis points. That's relative to the RBA's cut of 25. So we think that's probably a fairly good guide of what to expect from here, that there'll be almost but not quite complete pass-through. But at the end of the day, the RBA is targeting the mortgage rates that borrowers eventually will receive. So if the RBA does have a view that consumers aren't getting quite as much reduction in rates as they should be, then the RBA will just cut the cash rate by further to compensate.
The RBA has lowered interest rates by 1.5% in the past 12 months. Many expect another rate cut on Melbourne Cup Day. Are you expecting a further cut on this day as well?
Well, given that we view the RBA's action today as being almost preemptive or getting on the front foot, that reduces the need for them to follow through with a rate cut in November. So market had been clustered around the idea of a November rate cut because it follows the inflation data at the end of this month. So with them having basically moved ahead of the data, essentially the data has to be all that much softer to justify a back-to-back cut. So we think, if anything, today's action reduces the probability that we get something again on Melbourne Cup Day. And
Ben, how do you see Australia's economy performing in 2013?
Well, we think you'll see softer growth next year than you've seen this year, and in particular you'll have a different composition of growth. We have the economy in 2013 growing at around 2.5%, which is a little bit below trend, but the big change will be that the mining and resources sectors will be shouldering less of the burden, and it's going to have to be more work done by traditional consumer spending, non-resources investment, and also exports. So if the other parts of domestic demand are going to fire, that's going to require more stimulation of aggregate demand by the RBA, and that's part of today's story in terms of easing rates.
And finally, what is your short and long-term outlook for the Aussie dollar?
We expect that the Australian dollar remains high, despite the fact that obviously the RBA are easing policy. We have the Aussie dollar against the US dollar continually grinding up to around 106 in a year's time, and that's pretty much of the view that there are very few places in the world where capital can go and earn any kind of significant yield. The demand for Australian bonds has been very strong because of the fact that we have a central bank who has a cash rate that's non-zero, which is not something you can say in places like the US or in the Euro area, UK, Japan, etc. So we think that essentially the Australian dollar becomes strong, stays strong, and that's one of the reasons why, of course, the RBA has had to step in and ease policy, because we're not getting the relief through that currency depreciation channel that we ordinarily would in the current global context.
Thank you very much, Ben, for joining us today. Now, if you enjoyed this interview, then do stay tuned to keep up to date with the latest economic news and forex updates brought to you by the Dukascopy TV team. Goodbye.